What if I told you that you didn't have to wait 15 or 30 years to pay off your mortgage? Would you be willing to make some changes to your spending habits to achieve total debt freedom faster? Well, our Mortgage Payoff Calculator can help you see just what it takes to become mortgage free. In this video, I'll show you how to use this Mortgage Payoff Calculator in 5 simple steps. Hey everyone, this is Andy Hill from Marriage, Kids, and Money, a channel dedicated to helping you strengthen your family tree and live financially free. If you want to jump directly to the Mortgage Payoff Calculator so you can play around with it while we're talking about it, please use the links below or use the link in our video description. Okay, so here's how to use our Mortgage Payoff Calculator in 5 simple steps. Step number 1, enter your original loan amount. To start using the Mortgage Payoff Calculator, you want to input your original loan amount that you started when you got the mortgage. The original loan amount is the amount of money that you financed or borrowed when you took out the original mortgage loan. It's important to note that this is different from the current principal or the remaining amount of money that you owe on the mortgage. The original loan amount is not always reflected on your monthly statement. Instead, you may need to look at the account details online or the original loan paperwork. Before we became mortgage free, our mortgage principal started off at $195,000. Step 2, insert the loan term. The term is the amount of time that you have to pay off your loan in full. Typical mortgage loan terms in the United States are either 15 years or 30 years. We had a 15-year, so I'm going to add that into our calculator right now. Step 3, include your interest rate. Interest rates should be clearly displayed on your mortgage statement each month. Additionally, you can find this information in your original loan paperwork. Simply put, a loan interest rate is the price you pay to borrow money from a lender. Most American borrowers take out a mortgage with a fixed interest rate. That means that the rate does not change over time. Instead, it's related to the market conditions when you first took out your mortgage. This is helpful because your mortgage payments then remain consistent over the entire life of the loan. When we had our 15-year fixed mortgage, we had an interest rate of 3%. Step 4, enter additional monthly principal payments. Are you able to set aside extra money each month? Then you can make additional monthly principal payments to your mortgage. Additional monthly principal payments are supplementary or additional payments that you can make each month to the loan balance. When you set up these payments with your lender, you want to make sure that the payments are applied directly to the principal balance. By ensuring that your payment goes to the principal, you pay less interest over the life of the loan and shorten the time frame of the loan as well. Essentially, you actually pay off your mortgage early. If you aren't currently paying any extra money towards your mortgage, put 0 in this section. If you want to project how you could impact your mortgage, add a few $100 or $1,000. For us, we tried our best to add an additional $500 per month to hit our mortgage freedom faster. Step 5, hit calculate. After you've entered in all of the necessary information, you're ready to see the mortgage calculator in action. Hit calculate to get insight into your mortgage payoff. You can view the data in 2 different ways. The first view shows a graph of your mortgage payoff over time. Then you can also click the table data button. From this view, the mortgage payoff calculator shows you a breakdown of your monthly mortgage payments. Specifically, you see how much you pay toward the principal and how much you pay in interest each month. Do you want to see how fast you can pay off your mortgage? You can start with a $0 additional monthly payment and adjust from there. See the impact of an extra $50, an extra $100, or even $500 a month. You might be surprised to see the impact that skipping a dinner out or dialing back on some impulse spending can have on your mortgage payoff process. All right, let's talk about some Mortgage Payoff Calculator frequently asked questions. Now that you've had a chance to check out our Mortgage Payoff Calculator, you probably have some questions about paying off that mortgage early. Let's explore some of the most frequently asked ones. What are the benefits of a paid off house? Well, there are several benefits to paying off your house. The biggest benefit that we think of when it comes to a paid off mortgage is that peace of mind. Personally, there hasn't been a better feeling that we felt as a family financially, knowing that our family would always have a place to call home. In addition to the psychological benefits to a paid off house, there are mathematical ones as well. By eliminating your mortgage payment, you have freed up a significant amount of cash flow each month. The average mortgage payment in the US is between $2,883 for a 30-year loan and $3,759 for a 15-year loan. Once your mortgage is paid, that's a considerable amount of money left in your budget. You still need to pay your homeowner's insurance and your property taxes, of course, but you can now direct a huge chunk of money to investing, college funds, general savings, or even sinking funds for more vacations. By paying off your mortgage early, not only do you have extra cash flow, you can save over the life of your loan as well. Every month that you have a mortgage, you're charged interest. By shortening your loan, you pay less money in interest. Finally, a paid off home has more equity. This is money that can be used in the future if needs arise. Next question, should I pay extra on my mortgage or invest? It's a personal choice if you want to put extra money towards your mortgage or invest. Know that if you pay your mortgage off early, that frees up a considerable amount of money that you can invest later. However, it's also worth noting the magic of compounding. The longer your money is in the stock market, the more time you have to watch it grow. To keep things easy, we recommend you invest for your retirement until you hit coast fire. This is the point in time where you can slow down or stop retirement contributions and still hit your retirement investment goals. If you're curious if you're on track for coast fire, be sure to check out our coast fire calculator video as well. That one's free too. We'll put that link in our video description. Next question, when should I not pay extra on my mortgage? In many instances, putting extra money toward your mortgage makes sense. However, there are some situations where you might not want to. For instance, if you have high interest debt, you're going to want to tackle that first. A good way to determine what qualifies as high interest is to look at the different interest rates. If you're paying 20% or 25% on your credit card debt right now, definitely pay that off before putting extra money toward your mortgage. You also want to make sure that you have ample savings in your emergency fund. Paying off your mortgage offers peace of mind, but a house isn't nearly as accessible as a savings account. In the case of a financial emergency, you want to make sure that you have at least several months of income set aside in an emergency fund. If you're curious about that mortgage-free life, you can use our free mortgage payoff calculator to explore your current situation in 5 easy steps. Then you can adjust the additional payment portion of the calculator to run scenarios that will help you see just how much faster you can destroy this big old debt. To access our free mortgage payoff calculator, use the links below or access that calculator in the link in our video description. If you want to hear how my wife and I paid off our mortgage in less than 5 years, check out this video right here. Carpe diem.